In this video, we are going to tackle a practice question under financial liability. I think the video on financial liability comes before this practice question. So if you haven't watched the financial liability video, kindly do so to get yourself briefed with principles that the standards provides regarding financial liability. In this problem, we have JB Enterprise. So as we've been doing, we will read the question, discuss it, find solution to it before we work it out. JB Enterprise issued 1 million 1 Ghana cedi 4% redeemable shares at par on 1st April 2012, which was redeemable on 31st March 2016 at a 10% premium. The issue costs were 100,000 cedis. Constant annual rate of interest is approximately 9.28%. Ignore all tax implication. Show how this will be treated in the financial statement of JB Enterprise. The question has been read. It has left for us to discuss the key points that have been bold. So this is what we are going to do. So JB Enterprise issued 1 million. So 1 million is the number of redeemable shares. That's the countable number of redeemable shares. And each share costs 1 Ghana cedi as stated here. Each cost 1 Ghana cedi. So 1 Ghana cedi times this will give us 1 million Ghana cedi. So which means that the par value of the redeemable share is the 1 Ghana cedi times the 1 million, which is giving us 1 million Ghana cedi. 4% here represents the coupon. Always let's have that in mind. The rate that comes close to the par value or the nominal value, that represents the coupon. It represents the payment, the annual payment that will be made on 1st April 2012. So it started at the end of the first quarter or after the first quarter of the year. So it started in the second quarter. So it started at the beginning of the second quarter. So 1st April, which was redeemable on 31st March. So to be redeemed next year. That's 31st March 2016 at a 10% premium. So 10% premium means that so it won't be redeemed at par. It won't be redeemed at this value. It will be redeemed at a value which is 10% more than 1 million. And 10% of 1 million, you calculate it, then you add it to it, and that becomes the redeemable amount. So that is what the 10% premium talks about. The issue costs were 100,000. So here, since the entity JB Enterprise issued the shares to the general public or which people it was issued to, it incurred certain costs. And this cost here, as recognized by the standard, we can it's termed as the transaction cost, right? So it amounted to 100,000, and as provided by the standard, since this is a financial liability, issue cost is a deductible item, so we need to less it from the fair value of the financial liability. Since this question itself has elements of amortized costs, because there is nothing that shows here we have to fair value through profit or loss, because we have the necessary items here. So the issue cost will be deducted from the fair value, right? So this is the transaction cost. The constant annual rate of interest is approximately 9.28. So here it's ringing something, right? So it's telling us that this is what the effective rate of interest. So the rate that shows how the financial liability is going to grow over the period, right? We are to ignore all tax implications, so this transaction is not subject to any tax. We'll show how this will be treated in the financial statement of JB Enterprise. So in financial reporting, when we are to show how, we don't show how only by writing, but with figures, right? So you can make some narration from what I've said so far as a narration, then you make some calculations as well. So let's quickly go to the sheet and let's work it out, right? So we shall pass a journal entry to reflect the transaction at inception, right? It is always good to do that. So since JB Enterprise issued it, he sold it out, so he received cash, right? And since it is a financial liability, it has to be credited. So we are going to debit cash, the fair value, and credit redeemable shares, the fair value. And the par value or the fair value or the nominal value, it's 1 million. So we have it here to be what? 1 million. 1 million. And so we debit cash and credit redeemable preference. So being redeemable shares issued. Then we are to recognize the transaction cost as well, right? So this is for the transaction cost. So with the transaction cost, since it is a deductible item, we have to debit redeemable preference shares, sorry. So we debit it 100,000 because the cost is 100,000, and then credit cash because we are paying with cash 100,000. So we are done with the double entry. So this is just a double entry reflecting what has happened. So we just entered it into the journal. I love to do the T account as well to give us a more brighter view of it. So we are going to do that here too. So redeemable preference shares is a liability. So it has a credit balance. So since we debited cash, we have to credit redeemable preference shares with the 1 million. The 1 million. And then the transaction cost. Remember, we are debiting redeemable preference shares because the transaction cost is a deductible item. And we credit cash. So we debit redeemable preference shares with 100,000. Then the balance we are having, so this becomes our balance. Our balance is now 900,000. So instead of 1 million at inception, we are going to recognize 900,000 because the standard says so. The standard says that inception, fair value less transaction cost, if not fair value through profit or loss. So on 1st April 2012, the value of the financial liability is 900,000. So we'll quickly move straight to working the amortization schedule. Alright, so let's move to that. With our amortization schedule, realize that in the account, our balancing figure was 900,000. Just where we left, which was 900,000. So that is what will be our opening balance as at 2012. But remember, the reason here is 2013 is that we are preparing the account as at the end of the year, right? But the opening balance still remains the same, right? Okay, so we are going to charge effective interest rate of 9.28% on the opening balance. It is always charged on the opening balance. So 9.28% of 900,000, we have 83,520. And the coupon or the payment, the annual payment, fixed payment, is 4% of the par value, and that is 40,000. That is 40,000. So at the end of the first year, we are having 943,520 as our closing balance, and this closing balance becomes the opening balance in the next year. So we are going to have 943,520 as the opening balance. We charge interest of what? 9.28%. So that 87,559. And the coupon is still 40,000. That's the annuity. The same thing continues. The interest is 91,972. And the coupon is still 40,000 less. So you realize that with the amortization schedule, regardless of its position, whether it is financial asset or financial liability, the amortization schedule is the same, but just the meaning to the figures is what makes the difference, right? Let's get this straight. So here you have the closing balance as the opening balance for the subsequent year. So that's 1,043,051. Then here, when we get here, we are to take note of something. And this is what we have to take note of. Since the entity is redeeming the financial liability, or the financial liability is going to be redeemed, we shouldn't have any closing balance of the financial liability at the end of 2016. So we have to find a way to make this place zero. But normally it's not zero because of certain discrepancies, especially relating to the effective interest rate. Due to its approximations, we may not have a specific figure. So what we need to do is to find the total payment and find the difference between the total payment and the opening balance. Then that gives us the effective interest rate, and automatically here is going to be a negative, a zero figure, right? So let's do that down here. Okay, so we have this. So we have our fair value. Our fair value is 1 million. Our fair value is 1 million, and our coupon 4%. So remember, in the last year, you are still going to pay coupon, which is what? 40,000. And the premium is 10% of the face value or the par value. So we are to 10% of 1 million is 100,000. So in total, we are going to have 1,140,000 as the total payment. Let's note this. We're going to have this as the total payment. That's 1,140,000. So our total payment is going to be 1,140,000. So look at what we have here. So automatically, this difference becomes the interest rate. So let's punch it there. So we are going to have 96,949,000, and we have nothing here. Zero. So now try to calculate 9.28% on this face value. You realize that you get a value that is approximately equal to this value, and the difference is due to the interest rate for itself being approximated. Right. Let's quickly move to how it is going to be shown in the statement of profit or loss. Since it is a financial liability, the effective interest rate will be classified as a finance cost. In other words, it will be in brackets to be an expense, right? So we are going to have this as 2013. So 83,520. So let's quickly move to our statement of financial position, most important one. So we realize that with Excel, it has automatically done that for me. So now let me zoom out for you to see what we did. So automatically, Excel has brought the closing balances there for me. So at the end of 2013, we have this as our closing balance for 2013, this as our closing balance for 2014, this as our closing balance for 2015. Remember 2016, it is going to be redeemed. So we won't have any value present. Thank you very much.